Most investors have never even heard of this equation, but quants use it to simulate markets, overcome risk, and predict stock prices. It's the hidden code behind all of modern finance. Understanding it will fundamentally change how you think about investing forever. Every stock price, every trade, every chart you've ever seen is shaped by this equation, and it all has to do with the fragile balance between time and risk. But first, let's zoom out and make sure you understand everything you need to in order to bring this equation to its fullest potential. And don't worry, I'll teach you how to build a profitable investing strategy with it if you stick around till the end. You've probably heard about indexes like the S&P 500. There's a reason why most of your retirement account money is probably in them. Stocks go up over the long term because, given enough time, they create actual value by doing business and profiting. By investing in stocks, you make money off their increase in value. If you invest in an index and wait for multiple years or decades, you will, over 90% of the time, be profitable as the stock grows exponentially. But that's boring and you can't wait that long, so decide to gamble instead by day trading and whatnot. However, over the short term, stocks are a lot more random. They pretty much go up and down with no rhyme or reason. For instance, 2023 and 2024, in general, were incredibly bullish years as the US economy recovered from 2022's recession and the development of AI is accelerating. We can establish a clear cause and effect for the price movement over this relatively long time frame. But at 8:46 AM on September 21st, 2023, the market went up approximately 0.04%. Can we find a reason why? No, it's just a completely random fluctuation. We know that stocks go up consistently over the long term, so what's going on? It seems like stocks have two forces driving their movement, the long-term growth and the short-term randomness. It's completely random on smaller time intervals, but if you zoom out, there is a clear direction. It's kind of like a drunk guy walking out of the bar. Each step is random, but he somehow always ends up back at his ex's house. Here's an excellent explanation from the YouTuber Epsilon Delta Main that shows you what this actually looks like.
Let's start with something that can be modeled with ODE, like constant acceleration motion. Plotting a solution against time, it follows a quadratic trajectory.
ODE refers to an equation with no randomness component, and where all terms are deterministic functions of time. He used a quadratic example in the video, but keep in mind that in our case, it's exponential.
Now, let's introduce some random noise to the model, which could be caused by turbulence or market fluctuations or for whatever reason. Then, our system becomes non-deterministic, meaning that even if we start with same initial conditions, we cannot predict the exact path it will take. While the actual trajectory is random, the time evolution of the distribution remains deterministic.
All of this can be described by this differential equation. I know it looks scary, but just stick with me for a second. If you aren't familiar with calculus, just know that the d in front of each one of the variables refers to an infinitely small change in them. In order to find the actual stock price, what you do is solve the differential equation by taking the integral of both sides, which is essentially added together an infinite amount of infinitely small increments in the stock price, giving us the actual movement of the stock. I'll circle back to this later in the video since there's some important things that you need to understand first, so stick around for that. By the way, stochastic differential equation is kind of a mouthful, so people often shorten it to SDEs. Not! S refers to the stock price, mu refers to the yearly return, dt refers to the infinitely small portion of time, sigma refers to the yearly standard deviation, and dwt refers to the random shock over this infinitesimally small time interval. I know I said a lot of words so far, but not how you can actually make money off of this. I promise we will get to that in due time. Have some patience, little one.
Give me my money!
Let's get to the W of T, which is the Wiener process. I'm not sure why it's called that, but it's called the Wiener process. Let's just be mature adults and get this over with. The Wiener process describes Brownian motion. In the early 1800s, a botanist named Robert Brown observed the erratic movement of pollen particles suspended in water, and how they move completely randomly. However, since he was just a botanist, he basically said, "Yo, that's crazy," and then didn't do anything else with it.
Oh my God,
Almost a century later, Albert Einstein picked this up and determined that this was due to the millions of collisions happening between the water molecules and the pollen particle happening at the same time. Technically, if you knew the exact information about every water molecule, it's not random and you can explain it. But that's pretty much impossible, and so it's functionally random to our eyes and can be modeled by a stochastic process. Why do stocks follow the stochastic Brownian motion? Well, the millions of people constantly buying and selling the stock act like these water molecules. If we knew everything about everyone and had an algorithm advanced enough to process all the data, then every single increment of a stock can be completely explained. But again, that's impossible, and so it's functionally random for our purposes today. Approximately, of course. A Brownian motion has 4 requirements. Requirement 1 is that the path starts at a value of 0. We can fulfill this by subtracting out the initial stock price, so the chart now represents profit and loss rather than the stock price. Easy. The second condition is that it's continuous. For now, we're assuming that we're in finance wonderland where all conditions are ideal, so there's no reason to think otherwise. The third condition is that the distribution of returns is normal. This isn't obvious, so let's take a closer look. When you put a drop of ink into a bowl of water, it instantly diffuses and spreads throughout the entire bowl. The ink spreads not because it wants to, or because some law of physics demands it, it spreads because that's the most statistically likely outcome. There are countless ways for molecules to spread out, but only a tiny handful where they cluster together. So when you zoom out and watch it happen, the ink cloud expands, not by design, but by probability. So what does this mean in terms of the stock market? Here's a simulation of lots of different particles experiencing Brownian motion and an x position density function. If there are more particles at a particular x position, then the graph is higher. This ends up revealing a normal distribution with a variance that increases linearly with time. And since variance is standard deviation squared, that explains why we divide the standard deviation by square root 12 and not 12 when going from months to years. The more you know. Here's what it looks like in terms of stock prices. This right here is known as a Monte Carlo simulation. If you rotate your head a bit, the average of all the paths of the stocks looks kind of like the normal curve. This is interesting. While the Wiener process is normally distributed by definition, even if it wasn't, the stock's paths would still be normal because of the central limit theorem, if you remember what that is from your statistics class. We're basically sampling from the Wiener process an infinite amount of times and then adding them together, meaning that the distribution is normal according to the theorem. The normal distribution means that most price changes cluster around the average, being 0, with few being at the tail extremes. You can see this reflected in option prices. An option that's 90% out of the money is worth far less than one 10% out of the money, because the probability of a stock going at least 90% is much less than 10%. However, stock prices are only normal over the short term. Over the long term, the upward drift comes back in, making it log normal, but I'll explain that later. And then finally, the fourth condition is that each price increment is independent and identically distributed. The previous movement does not influence the next one. This phenomenon is known as the random walk. Alright, that was a lot. Let's just make sure you fully understand what just happened before we move on. Basically, for each small step in time, dt, there's a small step in price, ds, that is normally distributed. These increments add together to form the stock's movement. As time goes on, the stock's price is more likely to be farther away from the starting point, either up or down, as these price increments compound. I've been talking about these arbitrary, infinitely small price increments this entire time, but now let's put it all together, literally, and find the equation that actually models how a stock moves. We add together an infinite amount of these infinitely small steps by taking the integral. Now first, let's assume no randomness at all and just solve the equation for drift. The differential equation just becomes ds equals mu times s times dt. This is a very simple equation to solve, and most of you probably recognize it as the differential form for exponential growth unless you're absolutely stupid. Here it is solved. In this case, the constant e to the c, remember that c is an arbitrary constant that's added when you integrate, represents the initial stock price. Now, some of the very astute among you might notice something. I defined mu earlier as the yearly return of the stock, but here, mu itself does not act as the yearly return. If it was indeed that, then the equation would be 1 plus mu to the power of t, not e to the mu times t. But stick with me here, those are the same equation. Approximately, maybe around 90% accurate. For very small values of x, 1 plus x is remarkably close to e to the x. This is because of the Taylor series of e to the x. A Taylor series is an infinite sum of polynomials that can be used to represent any function. The Taylor series for e to the x is 1 plus x squared over 2 plus x cubed over 6 and so on. For values of x that are close to 0, such as something like 0.08 per year that we use for stocks, all the terms of exponents decay to near 0, so 1 plus x alone is a very good approximation. Basically, defining mu as yearly return is technically wrong, but it's good enough for our purposes. I promise I'll stop yapping about irrelevant stuff now and actually get to the whole point of this video, which is what happens when you add the Wiener process back into the equation. This turns out to be a very hard integral to solve, mainly because the usual methods of integration used in calculus break down the stochastic part as well. So I reached out to some college finance professors, some quants, people who really knew what they're doing when it came to this, and asked them to solve the integral for me, but they all just told me to screw off. So instead I had to resort to using ChatGPT. I'll break my promise and start yapping about irrelevant stuff again. Basically, since dt represents an infinitely small portion of time, when you square it, it becomes 0. Higher order differentials always become 0 in regular calculus, which makes things much easier for us when differentiating or integrating. For instance, the definition of the derivative that you learned in the beginning of your 11th grade math class only works because dt is the only differential term that actually doesn't go to 0. However, this is not the case in stochastic calculus. We already established that variance scales linearly with time, so dwt squared actually equals dt, not 0. This makes things impossible for the regular calculus students. The only way to solve this is through Ito's lemma, which is basically the chain rule for stochastic calculus. God damn it, this is getting complicated. Basically, it accounts for how randomness is affected by curvature, since you're more likely to sample unevenly around the current value. At least according to ChatGPT. So, once we solve this differential equation for s, we get s equals s naught times e to the mu minus half sigma squared t plus sigma times wt. If we take the natural logarithm of both sides and apply some basic log rules you learn in your algebra class, we get this equation. Now, look at this. The third term is just an arbitrary constant multiplied by the normal Wiener process. The first term is just an arbitrary constant, and the second term are arbitrary constants to just shift the normal distribution. This means that while the stock's price is not normally distributed, the logarithm of it is. Like I said earlier, over the short term, movements are normal, but over the long term, they are log normal. If there's one big thing to take away from everything I said so far, just understand that in the short term, the drift term of the mu and dt is negligible, and the stock prices are governed solely by the stochastic Brownian motion, while in the long term, the Wiener process term with the sigma and dwt is somewhat negligible, and stock prices are mainly determined by the upward exponential drift. This is because long-term drift scales with t and short-term randomness scales with square root of t. On very small timeframes, square root of t is much greater than t, and vice versa for very large timeframes. It's actually really satisfying to see how math justifies what our intuition tells us. And by the way, the Black-Scholes equation, the trillion-dollar equation that Veritasium talked about, is the direct consequence of this equation. The Black-Scholes equation describes the price of derivatives, most commonly options. They're called derivatives since they derive their price from the underlying stock. So we define an option as a function of both time and the stock's price, then take the mathematical derivative or the financial derivative. We need to use the chain rule, and so we use Ito's lemma. Which gives us the Black-Scholes equation for the value of an option price. So suck it, Veritasium. You have a PhD? Well, I have 700 YouTube subscribers. Wait, I just realized that sounded kinda lame. If you want to help me, then please click the subscribe button. Please. Okay, so what does this actually have to do in terms of making money? Let's talk about that now. Lots of people have their own strategies as to how they go about making money in the stock market. Quants use incredibly advanced calculus to do it. Many retail investors read news articles and look at the fundamentals of the company. You probably do about looking at how many rocket emojis there are at the end of a Wall Street Bets due diligence post that was written by a guy that was higher than the Burj Khalifa. But every strategy, fundamentally, just boils down to trying to buy a stock before it goes up, then trying to sell it before it goes down, making a profit. If a stock goes up, that means it's increasing, and so the first derivative is positive. If a stock goes down, that means it's decreasing, and so the first derivative is negative. So in order to make money, why don't we just take the derivative of a stock's price and buy whenever it goes positive and vice versa? Obviously, there's like slippage and transaction costs in the real world to deal with, but wouldn't this work in Finance Wonderland? So here's the Wiener process graph. Let's find the derivative at this point. Wait, there's a problem. The derivative is the slope of a tangent line at a point. But as you zoom in, it never becomes smooth. It's infinitely jagged. It's a fractal. And so it just fluctuates infinitely and never actually converges to a single slope. This means that if a stock crosses a price level at least once, it must do so an infinite amount of times as well. Whoa. Brownian motion is just too rough to have a well-defined tangent at any point. This means that stock prices are continuous everywhere but differentiable nowhere, meaning that there's no way to ever know if it's going to go up or down in the short term, since the universal strategy described earlier is dependent on that. Okay, I know I just said I would teach you how to make money, but all I did was just prove that it's impossible to do so. But stick with me here, it'll come full circle by the end. This is kind of a supernova moment. This means that, in Finance Wonderland where everything is ideal, there is no way to have a consistently profitable trading strategy. The consistently profitable trading strategies that may exist in real life all only make money by taking advantage of the fact that everything isn't ideal, but obviously that's incredibly difficult. There's a reason why upwards of 90% of day traders lose money. Now, notice how I said trading strategy and not investing strategy. Making money in the short term is impossible, but in the long term it's very much possible. If we take the derivative of the long-term exponential function for stock prices, we get another exponential function that's always positive. This means that the stock's price is always increasing, and so you should always buy. This is why you're holding those index funds in your retirement accounts. Another way we can prove this is by calculating the expected value of the Wiener process. In your statistics class, you might remember seeing these tables and having to multiply each value with a probability and adding all those together to calculate expected value. In this case, since there's an infinite amount of possible values, we use an integral rather than a sum. We're taking the integral from negative infinity to positive infinity of x times the formula for the normal distribution. Remember that t is the same as standard deviation squared, and so I just subbed that in. This is a pretty straightforward integral to take when using u substitution. And we get this function as the antiderivative. The expected value is this function's value at infinity minus the function's value at a negative infinity, which is just 0. This means that your expected profit in the short term is, well, 0. This makes sense, because if the stock is going up or down randomly, it'll just average out to be 0. But all hope isn't lost, because once you wait a little bit, a long-term drift term takes over. Calculating the expected value of this term results in a non-zero number, so you will actually make money over the long term, which reinforces what I said all the way at the very beginning of this video. The expected value of the entire equation is S0 times e to the mu times t. So while there is some randomness in the stock, on average, you would expect prices to follow the exponential trend of compound growth. Remember when I said that short-term and long-term movements were normal and log normal respectively? Well, the normal distribution has a mean of 0, while the log normal distribution has a mean that's greater than 0. This shows the expected profits graphically. It's cool how I literally prove this in 3 different ways and they all give us the same exact conclusion. Math works, guys. So how do you make money? Well, the only way to win is not to play. Don't try to actively trade. Don't try to beat the market and generate alpha. Don't try to gamble on risky options that flush your Wendy's paychecks down the toilet. Instead, you just need to invest in long-term index funds and bet on the drift term making you money rather than Brownian motion. After all, which one do you trust more? The consistent profits that companies bring in over time, or something that's literally called the Wiener process? The video is not over yet, so don't click off. I have one more thing that I need to tell you and that you need to hear. Like I said earlier, the pollen grain or stock price was not technically random, because he could have just summed up all the forces the water molecules were exerting on it and calculated the movement that way. It's not random at all. There is no fundamental randomness in our universe. it just appears random to our eye, but if you zoom in, everything can be explained. So, if nothing is random and everything can be explained, does that mean that we don't have a free will? If you took an incredibly advanced computer and started simulating from the beginning of the universe, wouldn't it be able to predict everything because nothing is random? Is everything already predetermined? Well, no. I do think you have a free will. I'll give you a choice. You can either click on this video explaining everything you need to take index funds to their fullest potential so you aren't reliant on random fluctuations, or you can watch this video explaining more advanced finance topics like this one, which you'll definitely enjoy. But those are your only two choices. You can't watch another video besides these two, so I guess you don't have free will.